The Redbox stock has been the topic of many conversations recently, and in today's video we're going to look at its price actions, the recent developments, the technicals, and my opinion on if you should be buying the stock. As the market is still very volatile at the moment, we should be mindful about which positions we pick, as well as their individual timing and the exposure. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. In recent trading sessions, Redbox has somewhat of a pullback from the previous highs by some 20%, and this is quite significant in the wider context of short squeezing under challenging market conditions. We know for sure that this is not due to the short positions putting pressure, because otherwise the pullbacks would be much more sustained, but rather a natural profit-taking procedure that the recent new highs have caused. It's quite simple to understand the shareholders and traders who have been holding the stock since early 2022 to finally be able to realize some of the massive profits after a while. And for many of them, I think it's just to relieve some of their existing positions and exposure in Redbox at a relatively higher price level without even necessarily incurring any profit. We should remember that even if the current price seems quite high so far in 2022, the Redbox stock has seen its share price fluctuating at a significantly more volatile spectrum. In terms of fundamentals, I haven't seen any significant event from the company, and frankly, I don't believe that they're going to play a significant role in influencing the stock price action in the days and weeks to come. Keep in mind that the main reason behind the recent uptick is the potential for a short squeeze. We all know that a business that rents DVDs for a living may have serious challenges yielding big profits in the current market and the current economy. The greater environment is also something to watch out for, as the VIX number is making new highs in almost a decade. And if anything from the recent weeks are to go by, I think that the collective psyche of retail traders is relatively more risk-averse than under other circumstances. Now, let's take a look at the technicals of the stock. The trading volume of Redbox has recently been 50 million shares, compared to an average volume of 26 million shares. Over the previous 52-week period, its price fluctuated between $1.61 and $27.22. The trading volume is a metric that can tell you how many shares are being exchanging hands, and whether there's a lot of activities and attention on the stock. It often gives you a first idea about the popularity of the company, and when we use it to compare with the average volume, it can also tell us if the company is enjoying additional momentum to reverse its trend or to break through the current resistance levels. Even when the current volume is lower than the average, it's an interesting indication because it may signify that the trend may reverse soon. The market cap of Redbox is currently around $460 million versus the enterprise value of $297 million. To put simply, the market cap is the fair market value the company bases itself on with the current market sentiment, along with the company's own reputation and other macroeconomic factors, whereas the enterprise value is usually the cost the company has already paid for its assets after paying off the debts. It's worth mentioning that one of the most significant assets for a lot of growth companies may be the intangibles, meaning that they may not be equipment or inventory, but their promises that this company may grow significantly in the future, such as the existence of charismatic leaders and management, pledges for major contracts, blueprints, and schematics for new products. For startups, most of their valuations are based on those intangibles, which may have been valued in more favorable market conditions. In concrete terms, this means that there can be a huge difference between the market cap and the enterprise value, giving a false impression to market participants that the company is trading at a discount. It's only trading below the book value, but it doesn't mean that the company itself is necessarily undervalued. It's also possible that the company itself may have been overvalued in the first place, and since then it's just going back to the reality. As we compare the current price to the historical price fluctuations, the stock is 360% higher than the 1-month low, 570% higher than the 12-week low, and 627% higher than the 52-week low. On the options market, which often gives a hint on the market sentiment about where the stock price is likely going to go next, the implied volatility is 270%, versus a historical volatility of 317%. The put-call volume ratio is currently 0.49. It is normal for many stocks that tend to have a higher put option volume than what they deserve, as many institutional investors hedge their long positions by buying put options. The most recent volume of options traded has been 65,000 contracts a day versus the 30-day average volume of 70,000. In terms of open interest, the most recent volume of open interest has been 385,000 contracts versus a 30-day average of 141,000 contracts. The option contract is a derivative from the underlying security, giving participants the possibility to have the right to either buy or sell the security at a predetermined strike price. Buying the contract would give you the right, and selling it would give you the premiums, with an obligation to execute the contract if the counterparty chooses to do so later as well. It's often said that you can evaluate the likelihood of the scenario based on the opposite of what the current ratio actually is. If there's a lot of put options, then there may be possible uptrends on the move, or that the reversal may happen if there are lots of call options. The reasoning behind the theory is quite simple. Most option contracts expire worthless. In terms of its shareholder structure, institutional shareholders own about 300% of the current outstanding shares. This means that many are borrowing shares that they don't actually have from the brokers. The biggest shareholders include Apollo Management Holdings, Vanguard, and Millennium Management. It is relevant to understand the shareholder composition of a company, as this can help us to determine if you should hold the stock long-term or to view it as a trade opportunity short-term. If the stock is mainly held by retail traders, this may be a sign that the stock lacks the depth to justify long-term trust from shareholders. Typically, the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. There's obviously lots of exceptions to this, as many great companies are also mostly held by retail traders, but that tends to be the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes when there are significant short interest in the total volume, this may be a sign that there's an organized shorting operation going on, such as what happened with GameStop and AMC. The current short interest is 45% of the total floats, with 56% of the transactions coming out of the dark pools. Usually, if the short interest is above 15% of the total volume, with a significant portion of it coming out from the dark pools, this may suggest that there are institutional positions taken to short the stock, and there would be potentials for a short squeeze. My recommendation on Redbox is to buy the stock now and to commit a large portion of your allocation. The stock is going through a relatively large period of volatility, and this event is time sensitive. I would recommend to commit between 1 to 3% of your portfolio, and would also recommend to split the allocation in 40-60 or 60-40% so that you can purchase more in case of further retracements. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect the investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally, that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.